Would you like a guaranteed income for the rest of your life? Most people would say yes, but Social Security benefits may not be enough, and most companies no longer offer pensions, and that's why annuities exist. More than 200 billion individual annuities are written in the US every year, which speaks to its popularity. But what are they? Are they worth it? And do you need one? That's what we're going to talk about today. Hi, I'm Prudence, CPA and a fee-only financial planner. I provide tax and wealth strategies to professionals and small business owners so that they can effectively create, accumulate, and protect their wealth and live the life they want. A few weeks ago, I interviewed Sherry, another personal finance YouTuber with 23,000 followers. She mentioned how she used annuity to help her family and hundreds of clients protect their retirement income. And some of you asked for more information, so today I will present an independent view on annuities and how you can use them to achieve your financial goals. There are a lot of information, so get ready. First of all, what is an annuity? At the core, it is an insurance contract between you and the insurance company, most commonly stating that by giving them some money or premium, you can get paid continuously for the rest of your life, starting immediately or at a future date. The one exception is a multi-year guaranteed annuity, or MYGA, which doesn't provide a lifetime payout, and I'll talk about it in a little bit. There are many types of annuities on the market. They differ in how you pay the insurance company and when and how much they pay you back. But as a rule of thumb, the earlier you make a deposit, the bigger the deposit. The later you start getting paid back, and with less guarantee, the more payout you will get each period. To begin with, there are immediate annuities and deferred annuities. Immediate annuities pay out soon after you pay the premium, and deferred annuities usually pay out multiple years after your first deposit. For example, a Single Premium Immediate Annuity, or SPIA, is an immediate annuity with a guaranteed interest rate. Here's how it works. You pay a lump sum to the insurance company, and the insurance company will pay you back starting in 30 days for the rest of your life. Of course, the longer you live, the more money you will collect. However, the payments should best start after you are 59 and a half years old. Otherwise, you'll have to pay a 10% penalty on the payout. There are better sources of income for early retirement years, which I will talk about in a future episode. As for deferred annuities, you will have to wait a period, for example, 10, 20 years, or even longer, before starting to collect your payout. You can pay the premium either in a lump sum or several payments over time. And the period between your first deposit and your first payout is called the accumulation phase. There are many different kinds of deferred annuities: fixed annuity, multi-year guaranteed annuity or MYGA, longevity annuity, variable annuity, and fixed indexed annuity. Let's start with the most common and easy to understand one: fixed annuity. With this fixed annuity, premiums you put in will accumulate in value at a fixed rate, and it's guaranteed. As a result, your payout would be foreseeable when you sign your contract. Take Amy as an example. She's a 50-year-old female living in Arizona. She puts in $100,000 in a fixed annuity today and starts getting a payout in 10 years when she's 60. Her monthly payout will be $832 a month until she dies. And if she wants the annuity to cover her husband as well, who's 3 years older than she is, that means if one of them dies first, the other person can keep getting the payout until the second person also passes away. In that case, the monthly payout would be 11% less, at $741 a month. Similar to the structure of fixed annuities, there are longevity annuities, and the payout usually starts when you are 80 or 85. And it's usually significantly cheaper. So in Amy's case, if she wants the same monthly payout of $832 starting when she's 80 years old, she would only need to pay $21,936 today instead of the $100,000. And she could invest the remaining $78,064 into things that generate higher returns to pay for her retirement expenses before the longevity annuity payment kicks in. And this is an example of what financial planners would suggest in order to maximize your investment return while addressing the fear of living too long and running out of money. And of course, you can also change the premium amount, and the payout amount will go up or down proportionally. On the other hand, a multi-year guaranteed annuity or MYGA doesn't have a lifetime payout. Instead, it behaves more like a long-term certificate of deposit or CD, with significantly higher rates though. And the term can range between 3 years to 10 years. For example, in January 2023, the best rate for an MYGA with a 5-year surrender period was 5.6%. The surrender period means if you withdraw from the contract early or cancel it, you'll have to pay the insurance company up to a 10% surrender fee as an expense. The insurance industry uses it to keep the money invested with them over multiple years. On the other hand, a variable annuity allows the money in your annuities to shadow the performance of mutual funds and get a potentially higher return than a fixed annuity. However, your contract's value would change based on the market situation. And since your payout depends on the contract value, how much you can get during the payout phase would also be subject to market risk. If the market is down, it might significantly lower your payout. Also, those are usually more complicated and expensive products to have. One popular product type in the bear market is a fixed indexed annuity, which adds a cap and a floor to the annuity return. That means the value of your contract will never decrease, even if the index is down. And in a bull market, its value would increase based on the performance of the underlying index, for example, S&P 500, but up to a cap rate. Here's how it's calculated. Instead of using a fixed interest rate, the value of the contract could have 3 possibilities. Stay the same, increase by the percent the referenced index has changed, or by the cap rate. If the index decreases over the year, the annuity return rate would be 0. If the index increases, the annuity rate would be the same as the index change, but no higher than the cap, which is usually 3 to 7%. And nowadays, it's up to 8.5%. So for example, if you bought a fixed indexed annuity in 2013 with a 0 floor and an 8.5% cap, in the years when the index change is negative, your annuity return would be 0. So when the index change is between 0 and 8.5%, your annuity return would be the index change. And if the index change is higher than 8.5%, your annuity return would stay at 8.5%. As you can see, if you apply that to the market performance between 2012 and 2022, the cap significantly limits the upward potential. And since the stock market was up by double digits the majority of the years during that period, the trade-off of protection in the bear market versus limited growth potential in bull markets is not beneficial. In addition, there are many costs associated with variable annuities, and I will discuss them later in the pros and cons. After knowing the common types of annuities and how they work, we have an excellent foundation to understand their pros and cons. First, they provide peace of mind with all the fixed and guaranteed rates. And the fact that the payout would last till you pass away means you don't have to worry about running out of money, and that's a great feeling, especially for risk-averse people. Second, most annuities with fixed rates are relatively easy to understand. Certainly more so than stocks, variable life insurance, REITs, and alternative investments. So the risk of getting into analysis paralysis or overthinking is lower. Instead, you should be able to understand the product and make a straightforward decision fairly quickly. Third, if you use the fixed annuities right, they provide higher returns than other low-risk vehicles, such as checking and savings accounts, money markets, and certificates of deposits, or CDs. Fourth, if you get lucky and live significantly longer than most of the population, the value of your lifetime payout might be higher than if you invested in bonds. After all, the underlying asset of insurance companies is 70% bonds, 10% mortgage loans, and 20% other assets. However, on a higher level, people who pass away early subsidize those who live to be 100 years old, for example. And this chart by Michael Kitces, a thought leader in the financial planning industry, makes it clear. Each annuity payout comprises three sources: your principal, the interest return, and the mortality credit. A mortality credit is the money left over when an annuity owner passes away earlier than expected. And over the years, mortality credit grows to be more significant and eventually to be 100%. If your biological parents, grandparents, or ancestors had longevity, or if you are in excellent health and exercise regularly, your likelihood of living to an old age would be high. So longevity annuity might be a good bet for you. And that leads us to the disadvantages of annuities. The first on the list is cost, and one of the most prominent costs is commission. If you are an experienced investor, you know how damaging commissions are to your investment return. It means that the moment you hand over your money to the insurance company, the principal would immediately shrink by the percent of the commission that gets paid out. However, since you can't purchase annuities yourself like you could buy stocks, bonds, or mutual funds, the agents who sell you the annuities are paid a commission for their service. And the most lucrative to the agents nowadays are fixed indexed annuities, paying 6% to 8%. So if you invest $100,000 into a fixed indexed annuity, your agent will get $6,000 to $8,000 for that single transaction. That might also explain why you hear more about fixed indexed annuities than others. Besides commission, there are many other fees to hold an annuity contract. Administrative fees is typically 0.3% of the value of the contract every year, or a flat fee of $25 to $30 a year. Also, surrender charge if you withdraw money above the scheduled payment amounts in the first few years. And usually it's as high as 10% in the first year, and then decreases gradually until the surrender period expires. The insurance companies also charge a mortality expense for a mortality risk, ranging from 0.5% to 1.5% of the policy value each year. In addition, there's also an investment fee for variable annuities ranging from 0.6% to more than 3% every year. And there are countless writers out there, each promising a specific benefit, such as a guaranteed payout amount, pay periods, or death benefit. And all of them take an annual cut from your contract value, ranging from 25 basis points to 1.15% of the annuity's value per year. And that's not all. For indexed annuities, there's also a spread that insurance companies use to decrease the percentage they credit to your account each year. And unfortunately, not all of the costs are sufficiently disclosed or understood when people purchase annuities. So if you have only one takeaway from this video, you must remember that there is certainly no free lunch in the world of annuities. Every guarantee comes at a cost, and you pay a heavy price for the peace of mind through annuities. So make sure to think it through if it's worth it for you. And the second downside is the relatively low return. Even if we ignore the long list of costs I just talked about, the underlying asset of insurance companies are primarily bonds, which usually generate between 4 to 6% return since 1926. And in the grand scheme of things, there are many alternatives with much higher returns on the market. If you are interested, please let me know in the comments below, and I'll go through the expected returns of different assets in a future episode. The third is the inflation risk. The payout of annuities is usually a set amount every year, and it doesn't account for inflation or the decreasing purchasing power of money. There is an opportunity to add a 2% increase per year to deal with inflation partially, but that would significantly decrease the payout amount. For Amy, it would drop from $832 a month to $649 a month in the first year if the payout were to increase by 2% each year thereafter. And even that may only partially cover the actual impact of inflation if it exceeds 2%. And the last one I want to mention would be the lack of flexibility. An annuity is designed to be a long-term investment. So the insurance companies implement fees and schedules to incentivize you to stay with the contract, at least for the first few years. For example, Surrender charges, as previously discussed, and vesting schedules for opening fixed indexed variable accounts are widely used. Both result in a financial loss if you withdraw from the contract early. However, if you intend to make a long-term investment, that makes your time horizon long, and many other assets are available with higher returns. If for some reason you still decide to purchase annuities after hearing all the pros and cons, here is some advice to help you get the most out of it. First, choose an insurance company with high credit ratings that have been there for a long time. The last thing you want is an unexpected bankruptcy adding risk or complications to your payouts. Second, choose a knowledgeable and honest agent who tells you about all the costs, downsides, and even more efficient alternative ways to meet your needs. So if the agent only talks about the benefits and spends little time explaining the costs, turn around and run away as fast as you can. Also, try to avoid multi-level marketing companies and their agents, or at least research what they are truly about before engaging with them. Examples are World Financial Group, WFG, Premier Financial Alliance, PFA, and Primerica. We covered a lot of content today because annuities are not an easy topic. There are few comprehensive and independent sources of information due to the enormous marketing efforts of insurance companies and their independent agents. So good job on finding and watching this video. In summary, there are different types of annuities and countless products on the market, and new ones are coming out as we speak. They can provide peace of mind, faster decision-making, and higher returns than other low-risk vehicles, and people who live longer get a better deal. However, they have a lot of associated costs, provide lower returns than stock and alternative investments, and don't provide complete protection against inflation. But if you still decide to get annuities, remember to pick a trustworthy insurance company, broker, and agent. When you're in doubt, consult an experienced fee-only financial planner. You would save or make a lot more money by following their strategies and recommendations. I hope today's episode helped you understand the pros and cons of different annuities and inspired you to build and protect your wealth. If you liked it, please give it a thumbs up and share it with others. We're also available on your favorite podcast platform under Invest with Prudence. Please subscribe to my channel to learn more tax and wealth strategies to build the life you want. See you next time!